Morning, everybody. Welcome today to our last auction of 2023. I'm sure a lot of you are very familiar with John's credentials, John Loos, as an economist and strategist. John joins us today with an exceptional career, starting well back in the early days of our new constitution, where he was part of the National Treasury and part of the team that delivered the first expenditure framework, the medium-term expenditure framework, in the early days of Trevor Manuel's tenure as our Minister of Finance. John has a lot of accolades that we can present to you today, another of which is the fact that he was awarded the Reuters Economist of the Year in about 2004. John joined FNB in 2006, spent almost the last 20 years with FNB, carving out a wonderful career there as a property economist and strategist. The better part of his time with FNB Home Loans, where arguably he and his team set the benchmark for property analysis and research, specifically in the residential sector here in South Africa. And he joined property commercial finance in FNB towards the latter part of 2018. John's philosophy also includes that of what we could call human wellness, well-being economics, where he believes that the human well-being should be the end goal of any policy and decision-making in economics. John also has a very, very balanced lifestyle, doing a lot of ultra-marathons, ultra-triathlons. He's competed in bike races, Trans-Africa from Beitbridge to Cape Town, which is about 2,800 kilometers on a bike over 13 days. He's climbed Kilimanjaro. So he's a man that understands a work-life balance. I did tell him I'm going to take a bit of a dig of him as I close out my intro. John also claims to be a Blue Bulls supporter. And I felt that was something that hopefully we beat out of him this weekend when the Sharks take them on in Loftus. But he did tell me that he takes a microphone after me and probably will come back with something cheeky, I'm sure. John will be talking a bit about looking at the future policy framework and how that guides, I think, the economic framework moving forward, and giving us some insights and predicting what the economic landscape and property landscape might look in the near to medium term and the long-term framework. So I'd like to welcome John up today. It's a great pleasure and privilege. John, thank you very much.
Thanks, Greg. All I can say to you is the Super Rugby days have come and gone, and the Sharks are still not on the wall of honour. So I don't need to say anything more about that bunch of... you can auction Kings Park sometime, hopefully. Right, I've got to be quick. You know what? I'm going to talk without my slides because I know we've started a bit late, and the auction has to start on time. And I'm better when I talk without slides. So no death by PowerPoint today. Just quickly a few things about property and the cycle, the shape of the cycle going forward. Let's talk about that, because I'm actually a macroeconomist more with a property angle than a purebred property valuer or property economist or something like that. Now, we believe that interest rates have reached their peak. CPI inflation has been hovering up and down in recent months within the target range, going up to 5.9, which is at the edge of the 6% target range. But we do expect that the SARB will now give the economy a bit of leeway. They do have a mandate to do that too, to be economy sensitive as well. That 475 basis points later, they've probably done enough to curb domestic inflationary pressures. And they'll let food price fluctuations come and go, and for inflation to settle, they've probably done enough. So we think that we've, at 11.75 prime, we've peaked, and that the next move will be down, possibly only towards the middle of next year, with the SARB first waiting and seeing to make sure that they've more or less done the job, that those big inflationary pressures feeding through from the Ukraine food price spike and the oil price spike of last year are now a thing of the past. So that's sort of mildly positive news for the property market. And then mild interest rate cutting. We don't expect to see 7% prime in a hurry again. We believe that that last cutting cycle to 7% prime was an abnormal cutting cycle because of an abnormal crisis, being COVID. It was to cushion the blow. Now we're back to normal cycles, which probably means your bottom point's 10% perhaps 2 years from now or so, not the 7% of the past. So it's a mild stimulus in the short term for property. Property, if you look at MSCI total returns, they did slow half yearly already after some recovery out of COVID. Half yearly they slowed slightly in the first half of this year. You may get a property returns just going a bit slower during the course of next year. Property does lag the interest rate cycle very often and the economic cycle. So better economic growth next year, lower interest rates starting next year, but possibly on an annual basis, we only see the better returns the year after or so. There's a little bit of a lag until property starts to improve again. So a little bit of a stutter perhaps still to come because of the interest rate and economic cycle. But that's those are the questions that are less talked about, I guess. What most people always want to know from me is, but how do you see the longer term? Because we know that if property is one day to boom again, something like we had before 2008, for instance, if we ever to have something like that again, there's a lot of economic performance that has to change. Property is about the economy. And then the next question is, well, John, do you see that happening given government policy at the moment? Do you see us getting out of our stagnant economy into a higher growth economy sometime down the track in the longer term? The answer to that is, look, nothing's guaranteed. I mean, strange things happen. You could even see Sharks' victories one day. But you need to look at the signals. Back in the 1980s, when the nationalist government were losing support in the white electorate, the election results were dropping because there was an economic stagnation, and even the white electorate was starting to feel the pinch and slowly turning to the right and the left of the nationalist government, and the nationalist government's popular vote was declining. You started to see signs of grudging acceptance, I call it, that things had to change. Petty apartheid laws started to go. But the big deal didn't happen yet until 2nd of February 1990, when the big announcements were made, when they finally got to below 50% in an election, and I think that was the final catalyst. This time around, it's a different policy regime that needs to change. It's about allowing the best private sector on the continent to do what it does best, and that's to provide the service, the goods and services to the economy, to provide electricity, to provide possibly even rail services, to take a much bigger involvement in the economy in places where parastatals are battling to deliver the services, and to shift the boundary of government from being a deliverer towards just being a regulator, a smaller regulator, and expanding the scope of the private sector into sectors that government has traditionally controlled. That's the broad policy shift that needs to happen. Then the question people ask me, well, is that happening? And the signs are there. And I point back to the nationalists of the 80s, where that grudging acceptance, small signs, separate station benches and carriages going, and the petty apartheid laws slowly, as the pressures mounted. Those were the early signals that things were possibly going to change. Now, what do we have? Independent power producers coming in a bigger way. Not enough yet, but being allowed to do more over time. The solar solutions for a lot of businesses and houses coming in. This well-developed private sector able to produce the goods just needs to be allowed to on a larger scale. Needs to be allowed to eventually get involved in the transmission lines and investing in that. I believe that will come. Needs to be allowed to run rail concessions. There's early signs of that. It's not really working yet, but that's where the thinking's going. Needs to be allowed to run greater parts of harbors which are struggling. Well, there's a Philippines company that got a concession in Durban Harbor just the other day. So if we start looking at the signals, not worrying, well, we worry, but not just writing it off because it's too little, the concession allowance is is not good enough. To look at what this signals, then I think we start to see that that's where the thinking shift is going, and that's where the early signs are that the policy shift is going, that the best private sector on the continent will be allowed to do its job to a far greater extent one day, as the ruling party, yet again, like the one in the 80s, is losing percentages at the ballot box. Already we're into murky coalitions at local government level, lost a lot of support there. As the ballot box pressure mounts, that is the way policy is going, because I saw a survey of France Cornier, the political analyst, the other day, surveying key voter issues, key priorities for voters. Number one, job creation, employment, unemployment, poverty. Those were the big ones. And there's only one way to sort that out. You've got to start growing your economy more. The ruling party, the government knows it. Maybe they don't quite know how to do it yet, but we're starting to see the shift in policy thinking towards fixing the economy, towards allowing the private sector to create more solutions. And that's where I think it goes over time faster as the pressures mount, and as the political landscape changes. So I think those are the early signs, and that ultimately is some years down the track. It's not something that happens tomorrow, but some years down the track, that starts to pave the way for an ultimately very significantly better property market performance. That's the longer term cycle. That's not the short term cycle of interest rates going up and down. But the longer term, I get more optimistic as I start to see these shifts. Yes, under pressure from various sources, but you start to see the shifts when you look carefully. Too little still, but I think at some point it starts to gather steam out of necessity. And that's my very brief talk. I hope I've kept it within the time, but I want to see if there's any questions from the floor. If there's time for questions, that is. I'm happy to take a few questions and make a few comments. Well, I mean, theoretically, what is Warren Buffett saying always? Be greedy when others are scared, and be scared when others are greedy. Something like that. Certainly the worst time to be investing in property was the peak of that boom bubble cycle just before the global financial crisis. That was probably a very bad time. Where exactly is the bottom of what I call the super cycle? Well, the last real great investment opportunity was probably, in the previous big cycle, was probably about 1998. Prime rate was at 25.5%. Real property values were very low still. We'd just come out of the isolation and boycott era, and values hadn't shot through the roof yet. That was probably a great time on a national average. Where are we now? We have corrected significantly. To give you an idea, economists like to talk about real property values. So we take an inflation measure and we adjust prices to real terms. And in real terms, the property market up until last year, from about 2015, the all property capital value per square meter of MSCI had declined already by about 25%. So it's not possible to foresee where the exact bottom point is. Only with hindsight you can say 1998 was possibly it, or something like that, around there, 1999. But certainly the bargain hunting is better done now than probably in 2006 or somewhere at the peak of the cycle. I know the instinct of the majority of people, which is why these markets do what they are. The instinct is when everybody's buying and everybody's investing and capital growth is massive, then they think that's the time to buy, and that's very often the wrong time to buy.
See any change in the office environment?
I think the office market, if you look at the performance category, the three major commercial categories, industrial we know has done the best in recent years, retail somewhere in the middle, and office has been troubled. It's showing signs of stabilizing, and those who are going back to work have gone back to work, and it's not the sort of, people get a bit carried away. At one stage, you could swear that everybody was going to work from home and the office market was doomed, and it's certainly not that. There's a place for the office market, but I do think that for the time being, the relative performances probably stick with the office being the underperformer of the three. It's as I say, if you look at the capital growth and the income growths and stuff like that, that looks like it's also stabilizing. And the office market needs to shrink somewhat. It is shrinking somewhat, and in what way? Well, you do residential conversions with office and the like. And a smaller office market, we're probably not there. We know we've got a high national vacancy rate still. Well, not in P grade and A grade, but overall, if you take B grade and C grade and everything, there's a lot of surplus office space that has to go. So it's a process. So it'll be a smaller office market as a percentage of the total property stock. It will have its place. We are more flexible within our working environment, and that's probably going to continue to get more flexible as technology improves. But yeah, there's a space for good quality office space still. But I think it'll still be the underperformer of the three for the time being. Anyone else? Okay. Yeah, that's probably it. Thank you very much then.